Now we're going to look at money in terms of its liquidity. So we can define money based on how liquid it is. When we talk about liquidity, we're talking about the ability to turn our money into cash, into something that everyone will accept and that we can immediately spend. So when we look at measurements of liquidity, we have what are called M1, M2, and M3. So M1 is the amount of currency in circulation. So this would be our coins and our paper money or banknotes. Also in M1 is what are called demand deposits. And demand deposits are money that's in your checking account. So if you think about it, these are the most liquid forms of money. You can take a $20 bill or a toonie and it's recognized, people will accept it, you can spend it. Money that's in your checking account, you can use your ATM card, your debit card, and you can swipe it at the grocery store and they'll immediately remove the money from your checking account. So it's a very liquid form of money. So M1 is the most liquid form. And in Canada, we have about $90 billion worth of currency in circulation. The value of the coins and the paper notes is about 90 billion. Now, when you add in the demand deposits, M1 in Canada is worth about $1 trillion. So cash and coins in circulation really are only about 9% of M1. Most of the money we use today isn't actually coins and paper or plastic bills. Most of it is electronic. The next level of money in terms of liquidity is M2. So M2 is a little less liquid than M1. And in M2 we have everything that's in M1, plus we have what are called notice deposits. So notice deposits is money that is in a savings account. So think about the distinction between a savings account and a checking account. A savings account earns interest, and there's often a penalty if you want to pull money directly out of your savings account. And that's because there's a bit of a delay, right, from that account. So that requires notice to pull the money out of the account. So it's a little less liquid than the money that's in your checking account or coins and other types of currency, like a $20 bill. So M2 is less liquid form of money. It includes everything that's in M1. It includes everything that's in M1, but it also includes that money that's in your savings account or notice deposits. We can then look at an even less liquid form of money, which is M3. So M3 includes everything that's in M2. So recall what was in M2. That's M1, which is your currency and banknotes, your coins. That includes your demand deposits, the money in your checking account. And it includes the notice deposits, that's money in your savings account. In addition to all of that, so everything that's in M1 and 2, we have what are called certificates of deposits. We have government savings bonds and mutual funds. So these are all things that you can cash out, turn into money, make more liquid. And in fact, the value of M3 is about $2.6 trillion in Canada. So if we look at how much money we have in our country, it's $2.6 trillion. Now, some of it is in less liquid forms, like government savings bonds or purchase of mutual funds. Now, the reason we would accept these things as money, whereas we don't accept stocks and other bonds, like corporate bonds, we don't accept those as being money because they are not controlled by and owned essentially by the government. So when the government essentially dictates, or the banks, which are part of the Federal Reserve or our banking system, right? They're chartered banks under the Bank of Canada. Then there's a lot more control over them. And remember, it is the central bank, the Bank of Canada, that determines how much money is in circulation. So if the Bank of Canada has influence over what the banks can do with this then it can be part of our definition of money. So mutual funds, government savings bonds, and certificates of deposit are considered money. They're just a very less liquid form of money in Canada. Well, what about gold? Is gold money in Canada? Well, we don't actually recognize gold as money in Canada. It is a commodity. You can buy and sell it, just like you can buy and sell diamonds, but it is money. Okay? It is not recognized in exchange for that. Go to the grocery store and give them gold for your basket of groceries. As we said before, stocks and corporate bonds are not. Again, if you're outside of the domain of our banking system, controlled directly by our central bank, the Bank of Canada, then it's not money. Things that you can buy and sell are not money. Debit cards are not debit cards. It doesn't mean I've accumulated wealth. Same thing with credit cards. Doesn't guarantee that I've accumulated any wealth. So they're IOUs. Now, the money that you use to pay off your credit that the debit card is giving access to, so the amount in your demand deposits, that is money. Checks are also an IOU. They are not themselves money. If you have, doesn't mean you've accumulated a lot of wealth. So we have to go back to the beginning of our discussion here, which is medium of exchange. So someone has to accept it as payment for goods and services. Store of wealth, a way to, the more we have of it, the more we can buy. And it has to be a unit of account, a way that we can value good. So when we look at money in our economy, what is money? It's coins. It is money in your savings account, money in your check. It is money that you have in mutual funds and government bonds. They're more secure. They're typically guaranteed to earn or keep up with inflation. So those things are money. Whereas the list we looked at before, gold, credit cards, financial securities, not money.